So why isn't just buying the cheapest index fund the best strategy? Why? I don't really get this a lot from my clients, but I do get this a lot from advisors. So we do an awful lot of coaching with financial advisors around the country, both from stage to crowd and also one-on-one. And I try to teach them the philosophy that we use with you guys, with our clients. And the question, it's not the philosophy that they challenge. They understand the academics, they understand risk premiums, all the things we've covered in this podcast before. They understand risk in terms of standard deviation and whatnot. What they don't really get is that when we deal with expected returns, risk premiums, and where returns actually come from, they lose track of the fact that buying the cheapest index that says it does that is just generally speaking not the best strategy. So I brought some data. I'm sure you're shocked. And so if I'm going to use the S&P index, which I'll use in a second, I'm just getting that straight from Yahoo Finance. The other information is coming from, these are all indexes. So I'm using the Dimensional Funds US Large Cap High Profitability Index, Dimensional Funds US Large Cap Value Index, and the Dimensional Funds US Small Cap Value Index. I'm running these all from January 1st, 1975 through the end of November 2025. So roughly 50 years, almost half a century of data. And so here's how this all stacks up. The S&P 500 index from January 1st of 1975 through November 30th, 2025 had an annualized return of 12.5%. That's incredible. That's a half a century of returns of 12.5%. If I look at that index and I go back to 1926, so January 1st, 1926, and I run it through the same end time period, it's roughly 10%. It's a little higher than 10. So that's an amazing number. 12.5% is an amazing number. And what that tells us, let's just start with this, is that that's the reason why we buy equities instead of bonds, instead of fixed income. So I don't have the data right in front of me with bonds, so I'm not going to quote it to you. I'm just going to tell you that the 50-year track record of the S&P 500 is significantly higher than fixed income or bonds. And that's not surprising because we know that there are factors when it comes to investing. There are factors that we build in our portfolios that will tell us that if we utilize these factors, then our expected risk premium, our expected return should be higher. One of those factors is the equity premium, meaning stocks will tend to outperform bonds over long periods of time. That's what this is, right? At 12.5% roughly return over 50 years in the S&P 500 would tell us that, okay, on a moving forward basis, we don't know when stocks are going to outperform bonds. We just know that it's very likely that they'll continue to do so over a long period of time. Another factor is small company stocks tend to outperform large company stocks, again, over a long period of time. We don't know year to year, but over a long period of time that's true. And then we would further go down the road and say value stocks tend to outperform growth stocks over a long period of time. And more profitable stocks will tend to outperform less profitable stocks again over a long period of time. So those are all called expected returns, expected risk premiums is what we really call that. Now, if we get into some of this data here and we look at it, going back to the S&P, so over that roughly 50-year, half a century period of time, that's a 12.5% rate of return. However, if I look at the large cap high profitability index, so the S&P 500 is a large cap index. What I'm looking at though is what if we looked at an index that tracks not just large cap, but also the highly profitable large cap stocks? What if we said, okay, we want stocks over bonds and we want high profitability over low profitability? Well, that return in that index is 13.78% rather than 12.5 over the same time period. So there was an excess return there just by looking at other factors beyond just the cheap index, just the large cap stocks. And it doesn't stop there. So if I look over the same period of time and I look at large cap but value stocks, so now I'm looking at a large cap value index, that return is 14.19%. So even higher than the high profitability and higher than the S&P. Now, what's a value stock? Really, it's a distressed stock. It's a stock that's had some trouble. And so, you know what? There's going to be more risk there, which we'll talk about in a second. And because there's more risk, your premium, what you're going to get paid for, what you expected to be paid for the risk you're willing to take, should be higher and is higher. We keep going. What about US small value? Okay, so not just small companies rather than large, but small distressed, small value companies in the US. And this is 16.62%. So we go from the S&P of 12 and a half. High profitability large cap is 13.78. Large cap distressed or value stocks is 14.19. Then we've got small value stocks all the way up almost to 17%. So significant risk premiums there, significant expected returns over, in this case, almost half a century. Well, what happens in 2026? I have no idea. I don't know. I don't know what the next 5 years are going to look like. I don't know what the next 10 years are going to look like. Nobody even knows what the next 50 years are going to look like. But if we just look at the data and we look at what has been, for instance, if we go back 100 years roughly to the S&P 500, it's a pretty good expectation that we're going to get that 10+% in the S&P 500 on a moving forward basis over a long period of time, not based off of a prediction, but based off of reality of what's happened in the past, and saying, okay, well, all things being equal, that should continue. That there's no difference then when we look at high profitability or value stocks, et cetera. So then why aren't cheap indexes the answer? Why wouldn't we just buy the very cheapest index and throw our money into there because it's a lower price tag? And we've discussed this before in the podcast where we talked about the truth about fees. But forgetting the fees for a second, we need funds, we need mutual funds, we need ETFs that don't just stick your money in a cap weighted index and say, let's just allocate towards whatever the index is. But it says, no, if we're looking for large cap US stocks, let's apply the factor of profitability to that too. And let's overweight to the higher profitable stocks, thereby picking up in a higher expected return. If we're going to buy small stocks, we want to buy the smallest of the small stocks because that's where the expected return is, or the small valueiest stocks, if you will, in that category. And so we need funds and ETFs that do that apply these factors across the board and not just evenly divide your money inside of an index. While that might be cheaper in terms of like a price, I would submit to you that it's going to cost you money long term because you're foregoing what the math tells us, which is that there are risk premiums to pick up by allocating specifically to these areas. And cheap indexes just don't do that. I'm not knocking them. I'm not saying that they're bad or wrong. I'm just saying it's not what they're built to do. They're doing what they're built to do. They're just mirroring an index at a very low price tag. What I'm concerned about is your net return. I'm concerned about net of fees. Where do you fall? And what we're chasing then is an adjusted risk return based on whatever risk tolerance you're in. Of course, if you're 65 years old, you're not going to be in 95% equities like I am in all likelihood. Maybe some of your money's there because it's legacy, et cetera. But generally speaking, if you need income, you're not going to be, as allocated to equities. But the portions that are allocated to equities, we want to chase those factors that we know exist over long periods of time. Now, a quick data point here on risk. It doesn't come free. Okay, so these returns, it's not free. First of all, we have to know where they are. We've done that. We have to allocate towards them. Our portfolios do that. And then we have to stick with it. And the stick with it is tough because you worry about world events. We did a podcast on that recently. We're worried about world events and markets tend to fluctuate and they kind of pitter patter and then your heart pitter patters and you want to get out. Well, we know that. So if you look at the lowest returning category that we just talked about, which is the S&P 500, that gives you a 12.5% return over 50 years with a standard deviation of roughly 15. What does that mean? Standard deviation is a way for us to measure movement. Standard deviation, normal movement. The higher the number, the more the risk. Okay, so in this case, the standard deviation or the movement number is a 15 for the S&P. If I go all the way to the highest category, which was US small value, that's almost a 17% return, so significant upside potentially. But the standard deviation there annualized is over 20. So 15 versus 20, that doesn't mean anything to you necessarily, but if you want to know what that means to you, we can do the math with you and we can show you, okay, based on your portfolio, based on your allocation, here is your portfolio standard deviation, which will tell us what is the expected range of outcomes that you can expect in any given year. And that's a very important thing for you to know. Now, we've told it to you. Likely you don't remember exactly what that is. So if you want to go over it again, call us. Let's look at it. Every one of my new clients goes through that. We tell them what the ranges of outcomes, what the possibilities are, because you need to know that if we're going to go after risk premiums, well, the first word there is risk, and we're going to take on some additional risk, and we can mitigate that. We can incorporate more fixed income, more high quality short term bonds, and things to reduce that risk, while not giving up the chase for profit, the higher returns. But this is a really good, maybe a little numbers heavy. I don't know. For my veteran clients, you're probably following along pretty well, but it's just good data. It's just reminding us, look, there's a method to this madness here. We're not just picking random funds and sticking it in there. We're not just picking a random allocation and setting it and forgetting it. No, we're being very intentional about how we allocate your portfolio, when we rebalance that portfolio, and why we're doing it. And so that's it for today's podcast. If it was good, share it. This one's a little data heavy, so for your clients who love numbers, this would be a great one to share. And we'll see you in a couple weeks.
Joseph DeLisi is a registered representative and financial advisor of Park Avenue Securities, LLC, OSJ 5280 Carroll Canyon Road, 300 San Diego, California, 92121 619 648 Securities products and advisory services offered through PAS, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. CA Insurance License number 0D34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Guardian and its subsidiaries do not issue or advise with regard to mortgages, property and casualty insurance, and/or car insurance. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market, interest rate, issuer, credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. 8692505.1 expires January 2028.